traders. My name is Timothy Hellberg. I'm a professional trader since 12 years back, and today I'm bringing you a market report in collaboration with IMG FX, the People's Broker, for week number 14 of 2022. So let's jump right into it. The agenda for today is that we will go through the economical calendar, look for any events for the coming weeks, and if we had any events in the last week that were interesting. We'll look at last week's calls, what happened there. We had some quarter-end flows that threw a wrench into the analysis. That most of the analysis we did, but one of the calls that we did outperformed all of them like heavily. So let's take a look at that. We'll talk about Bitcoin, that is basically forming a cyclical rally, but there is a chance for pullbacks as the chart is standing right now. So it could be a well structure to either short on the lower time frames or get in for those more longer term long trades basically. We'll look at gold, where 1915 was breached but was not convincing, so we'll take a look at what that means. And then we'll end off by looking at euro dollar, that is looking a little bit bullish. We'll look at pound yen, that has some strong seasonals, and then we'll top this off by talking about the Japanese yen, or basically the currency market as a whole, talking about the comeback of carry trades, which is used to be one of the most popular trading mechanics in FX trading ever, and why it could be making a comeback. So first of all, let's jump into the calendar. So this week is very thin on the calendar. We don't have many news scheduled at all. Monday, pretty much nothing at all. Tuesday, we have the Australian dollar cash rate, which is basically the interest rate decision from Australia, which is very interesting because it's one of very few news that is on the docket for this week. So I would definitely keep an eye out for that, especially since we are going into a period of basically interest rate changes across the world, and we'll talk more about what that means in the last part of the report when we talk about carry trades. But we're really getting to a point where you need to start tracking interest rates for different currencies, because it can make a huge difference for your holdings. We have ISM later in the day for Tuesday for the United States, which is a good inflationary reading. So yeah, keep an eye out for it. Nothing market moving huge, but keep an eye out for it. Wednesday, the FOMC meeting minutes is the only thing that you need to keep an eye out for. Thursday, pretty much nothing at all, and then we'll end Friday with some unemployment numbers from Canada, which can be interesting. But once again, nothing huge there. When looking at central bank rates, you actually have on Forex Factory, for example, you have all the currencies here. So this is most websites, informational websites will have this kind of tracker. But I think that will suffice for now. We'll talk more about that later. Next up, let's talk about market sentiment. Looking at the VIX, as you know, we talked about the VIX before, volatility index. We have kept this downwards trend all the way down. We are moving down into the lower regions of the span, although not all the way down, but we are getting there. We are getting positive development in the Russia-Ukraine war. We are seeing Russia starting to step down a little bit. Market is feeling positive, as we've spoken about before. Positivity keeps on holding a grip in the market. If we take a look at the S&P 500, which is the big stock market in the United States, you can see we have had this huge bull run, we had a short-term pullback, and we've had a bull run again. So market is looking positive. It wants to be positive, like we've spoken about before. That is the sentiment. Don't try and trade against the sentiment until the sentiment shifts. However, there is a reason for this too, and let me talk about that, because that will lead me on to why some of last week's calls didn't work out. And that is because if you're a portfolio manager, if you're working for an asset management firm, you will be benchmarked against some kind of stock market index, most likely. And you want to outperform that stock market index, because if you don't, clients will pull their money. Why should clients keep their money with you if you can't outperform the S&P 500? Then they could just put their money in the stock market and they could earn a better ROI. So for that reason, when we get into quarter ends, you will have the issue sometimes. And this was a miss from my part last week. I should have taken a look at this more. I should have had it in mind when I made my trade setups for the coming week, because we saw the stock market rally last week, and the reason for that is pretty simple. Because when you're a portfolio manager and you want to outperform the S&P 500, you have to get into the market. If the market is looking strong into the end of the quarter, you want your portfolio to look even stronger. And the only way to do that is to increase your holdings into, for example, if the S&P 500 goes up 5%, then, for example, maybe Apple as an individual stock was up 10%, just as an example. So you want to increase your holdings so that you're actually going to beat the market at the quarter end. So for that reason, every time we have quarter end markets, it's very important to look at where are the major markets at. And when you're seeing a bull run in stocks like we did, then it's very important to understand that we might see a pretty big risk rally into that based on nothing fundamental or happening headline wise at all, just based on positioning into the new quarter. And that's what we saw last week. So with that said, let's jump into those charts and see the calls that we made for last week. First of all, we had Bitcoin that we were talking about breaking higher. Not going to spend too much time on this because we'll talk about Bitcoin again also. Bitcoin basically moving in sideways right now. So did it work out? No. Did it? If you took the trade, did it stop you out? No. It's a little bit higher than it was when the last market report was made. We were still inside this structure here. So that's more or less a break-even trade. Potentially a small profit, you could say. Gold. This is a tricky one. You know, we have this head and shoulder pattern working out. And you know, I said 1915, this blue line here was my line in the sand for where I would change my bias on long trades, and I wanted it to break out of this consolidation here and move higher, which we did, only to break down again and move back, even go below that, but we didn't get a daily close below the 1915 level. So for that reason, I'm treating this right now as just moving back into consolidation, not ready to make a move in either direction. We bounced back off this support as we've done previously. So without a daily close below 1915, I'm not going to change my bias. I'm still looking for long trades in gold, but I'm not in an active position. I would need to see some convincing move out of this consolidation to the upside. There is still a inflationary and macro based reason for gold to be higher in the long term, but I don't have a technical entry at this point in time. And last week you would have most likely been stopped out, as I was having my stop losses below 1915. We also took a look at euro dollar last week. We didn't really have a trade on it. We were looking for it to break. Our preferred trade was for it to break lower. It did not. It broke higher, and now we're back into the consolidation. Not much to say about that. If you had a stop loss against the highs, then yes, you would have been taken out of the trade. But I did not have a trade. I was looking for some kind of trigger to make me go into the trade, and I would have wanted that trade to be to the downside, so not a trade for me to take. Euro pound, this is the big outperformer of them all. As you probably remember, I was talking about getting long against this 618 fib level, using that as your support, and man, did we move up from that level. If you would have taken the trade last week from the levels where we were in the beginning of the week, had your stop loss against the lows here, you would have exited against the tops, you could have easily made a 4-to-1 risk-reward ratio, 1-to-4 risk-reward ratio, which is pretty amazing. This, as I talked about, this was a good hedge against my euro weakness bias, and that's why you have hedges, because this hedge outperformed all other calls. So for me, for example, the other trades that got stopped out, their loss were heavily eaten up by the profit on this trade, because it just pulled so hard. So great trade there. Hope some of you all got into it. Next up, Euro CAD, and on that note, guys, just let me tell you that this is not a recommendation to buy or sell anything. It's just my view on the markets. Keep that in mind. Always do your own research. Euro CAD, I was looking for a break lower. We got it in the beginning of the week, only to reverse it in line with the euro flows into the quarter end. Euro is a funding currency, meaning that you use it to fund other investments. When we had the risk rally that we had into the quarter end, you will have to fund your investments into other riskier assets, which will make you see the market buying euros, and buying euros will see the euro rising. I would not be surprised if we start seeing this trickle down now again, as we are moving into a new quarter and the quarter end positioning has ended. But let's see where it takes us. I don't really have a setup right now for EuroCAD at all. Okay, next up, Bitcoin. So let's look at where we're at right now in Bitcoin and what we want to do with Bitcoin. So, as mentioned, we are still in this structure right here. We're broken out of this lower time frame pattern. However, it's not a convincing chart on the higher time frames. We are in some sense doing posing a little wedge on the lower time frames. So my bias is still the same for Bitcoin. I think it's beginning a cyclical rally. I think it goes well in line with the rest of the market if risk keeps on being strong, risk sentiment keeps on being strong. As long as we are holding this support level here, as well as outside of this pattern here, I like it. If we move back into this pattern here, I would start viewing this as a consolidation against the lows, and I would have to look for long triggers to the upside again. Right now, I wouldn't mind playing it to the downside of a break here into the consolidation for a new test of the lows. That would be on a break lower, and I wouldn't mind playing it as a break to the upside if we break out of this. So it's really on the short term, it's really a trade that can go both ways. It's one of those trades where you need to be reactionary. You can't really predict this one. My long-term bias is still to the upside, but you would have to go on the lower time frames and look for shorter term triggers basically, and I would be inclined to trade Bitcoin in either way, long or short. I don't mind it at this point in time. I just wouldn't do it holding the trades for very long, at least not to the downside. Next up, gold. As I already touched briefly on, as long as we are in this pattern, I still like it to the upside. However, I'm cautious with entering trades at this point in time. I would have to see a break out of this consolidation and then some sign of chart pattern forming, like a flag, like some sort of divergence or breakout pattern that would make me consider going long again. Unless you are really trading the long term, doing really long term trades, I wouldn't mind adding long trades inside the consolidation against the lower support level here. That could be a play too, but that's really more a long term trade if you're into those kind of trades. Next up, euro dollar. So we are seeing a potential shift in sentiment for the euro with the funding currency coming into play. Is this the beginning of a bull run in euro dollar? Well, it's too early to say, but you know, we are putting in higher lows at this point in time for the euro-dollar pair. So I wouldn't be completely against looking for longs in this trade. I still think it's a bit premature, but the chart really holds up from last week. I would look for either this consolidation pattern still holding, a break below the 109.03 and lower for it to really start moving to the downside, or a more convincing type of price action to the upside. We only really have 2 lower highs at this point in time, so you would have to see one, in my opinion, one more lower high and one more higher high, then we would have the 3 touch confirmation, and then I could start looking for long trades in euro-dollar. But definitely worth keeping an eye on. We could be seeing a move to the upside. Pound yen. So pound is a very strong seasonal trade for April. So the pound generally statistically goes up in April. So for that reason, it could be a good time to look for currencies to pair the pound against. Now, I have highlighted pound yen here as one example. Well, why? Because it's not the most clear cut of them all. Why? Well, because I think it's if you're going to add long pound exposure into other currencies, well, we've seen the yen being so weak now against the pound that I wouldn't be surprised if we see a pullback at this point in time. We'll start seeing some yen strength, basically. At least not in the beginning of the new quarter. Now, yen can be risk sensitive, so it depends on what we see in the markets, but depending on what kind of pound exposure you start building up in other pairs, if you want to be long the pound against other currencies based on the seasonal patterns, then I think pound yen to the downside could be a good hedge against long pound exposure. So last up, let's talk about the Japanese yen and the comeback of the carry trade. So what is a carry trade? Well, let's go back to where we were with this central bank chart on Forex Factory. So what is a carry trade? So carry trade, I'm sure you guys have seen, when you are holding a currency trade, every time you roll it over at night, you have to pay or you get paid interest on that trade. It's called a swap fee. If you're holding a trade for a very long time that has a negative swap fee, then that can start becoming a problem for you. While at the same time, if you're holding a trade that is paying you swap, then you can actually start earning on that swap. Now, this is exactly what a carry trade is. A carry trade is where you borrow in one asset that has a low rate yield, and you invest in a asset that is high yield. Currencies are exactly that, because you have interest rates for different currencies. Now, back in the days, carry trades were very, very, very interesting, because you could have, for example, the United States could have a 4% interest rate. Right now, we are at 0.50, but we could have like 4% interest rate in the United States, while we had 0.5, for example, in the Japanese yen. That 3.5 percentage point difference in between those would have been your profit in just holding that carry trade. And add leverage to that, now obviously that becomes very interesting. Now, for a very long time, we've had central banks all over the world more or less at zero, so there haven't really been any possibility to do carry trades. But now, with the new market sentiment, with the new market environment that we're seeing after COVID, after the supply chain issues, everything, we are seeing central banks moving into doing these kind of rate hikes more or less everywhere, but some are faster than others. So for example, this means that you can start looking for and start making your own analysis on which countries are going to raise rates faster and which countries are going to raise rates slower. So, for example, the Japanese yen, generally speaking, is they are all very slow on hiking rates all the time. So, pairing them with any of these more aggressive hiking countries could have you in a position where you are able to make good money on a carry trade. And most importantly, what you need to remember is that this is a way where big financial institutions, pensions funds, etc., that are investing overseas, it's a way for them to make arbitrage. Arbitrage is the holy grail of all investing. Arbitrage is a risk-free return on investment. And how can they make risk-free return on their investment? Well, they do it by doing carry trade arbitrage. So by, for example, they are investing in another currency in another asset. So this gets a bit complicated. I'm not going to go too in depth on it, but say that you are investing in, say that you are a Japanese pension fund and you are investing in the United States stock market. Well, you can build that trade up by selling yen in the market at the same time as you are buying dollars and investing in the stock market. You can build that whole trade up in a sense where your risk for being in the stock market is offset by the carry trade that you are making profit on in the actual currency trade that you are in. And all big players, all big institutions, they are doing this. They will not doing this because they are very limited with the current currency rates to interest rates to be able to do that, but they want to do it. So they are some of the smartest people around the world working for the biggest institutions, funds and banks. They are right now sitting trying to predict where can they find in the upcoming months a interest rate differential. Can the yen stay at around 0 and can the US dollar get upwards towards 5? Who knows? But if you can predict that and you can start positioning for that right now, then not only will you start making money on the swap fees, but you will also have some of the smartest people and the largest institutions with the deepest pocket in the world on your side of the fence, pushing money into your trade. So, if you are intrigued of that, leave a comment and we can get chatting on that. Leave a like on the video if you like this. That's it for this time. Hope this was useful for you guys. I hope we all have a green profitable week. Stay safe and talk to you guys next week. Bye bye.